thanks to this, court situation in the US. And therefore, we're seeing, dollars up, equities are up, metals are up, and this is what's playing out. Just a couple of minutes to go. Watch out for tech as well, by the way, because of the excitement around NVIDIA. Nasdaq futures are substantially higher. Tech stocks, let's see if they can retain their
Global-facing
mojo.
indices will be in focus.
Global, metals, tech. That's how we start the morning. Okay, the bell's going to go off any second now. And we are opening with this 70-point up move. Make that 100 the moment the bell went. And it's actually a 100-point gap up opening. So looking very good. 24,850 on the screen, inching back slowly towards that 25,000 handle. And global facing, that's how it is. JSW Steel, 1.6%. Tata Steel, about 1.2%. Then you have all of tech. Infosys, 1.5%. You've got, names like HCL Tech, Wipro also higher. Let's not forget, stocks like Tata Motors. Easing tariff worries, obviously good news. US is a big market for that company. So that stock's higher as well. Banks actually in sync with the Nifty now, so not too bad. Axis Bank, for instance, up and about. IndusInd Bank is not reacting to the SEBI announcement. This is, quite understandable, frankly, because these, Mr. Sumant Katpalia has anyway been moved out. He is no longer the current CEO. And they will have to, these 5 individuals will have to sort of, deal with the market regulator independently. From here on, it's about rebuilding the business. So the stock, not too perturbed at this juncture. Actually, most Nifty stocks are positive. The only negatives are Tata Consumer, Bajaj Finance. That's about it. But this is a good morning, galloping away 120 points higher. By the way,
Tata Consumer has gone ex-dividend by 8 rupees 25 paise. So that explains the cut on Tata Consumer, Nigel.
Okay, all right. Well, a few stocks, though, that are calling for our attention. Avanti Feeds, that one, in fact, is a bazooka move this morning. Big uptick is what you're seeing on Avanti Feeds. I think it's reacting to a set of numbers, so good reaction out there. The EBITDA number came in high by closer around 36%. The margins are around 12.5%. The street likes it. The other stock that's doing well is Welspun Corp. We told you earlier today, the margins have improved. The EBITDA per quarter is the best that we have seen in numerous quarters. Good order book and net cash in the books. The street likes it. Sale as well, the volume growth of around 17%. Well, that was much better than what the street was working with. They have released some working capital. The street likes that as well. Marginally up, closer to 100%. IRCTC, I think that one as well had a good start to trade, so that should come up for you on the screen. IFB Industries, that's the other one of those bombed up names. But the growth out there was quite good. Margins didn't look that good, but the growth out there was good. It was better than one of their competitors as well. So I think that's why that stock is up closer around 3.5%. Invero Infra, that's the other one that's up closer around 4%. Big volumes out there. So though you have, the headline index that's up marginally, you have from the broader markets, lot of earnings reactions actually, and the stocks are off to the races.
Okay, some more then. Welspun Corp, 4.5% higher. Mishra Dhatu, Deepak Nitrite. Prestige Estates is also open with a 2.5% uptick. As the company says, they've completed 3 Mumbai projects and they will be handing over 700 residences and 130 office units. And plus, there is the bullish note coming through from Morgan Stanley on the entire real estate pack. So Prestige Estates has started off with some strength. Cummins, we were just talking about it, 2.5% higher. Birla Soft, revenues were soft. The company's top line declined by 5% on a sequential basis, but the company managed to expand their margins and the street is reacting to that. And generally, there has been an uptick in most of the IT names. I think one of the big drags today is Bharat Rasayan. And that is, I think, on the back of numbers. EBITDA for Bharat Rasayan is down 42%. EBITDA margins 13% versus 22%, and that stock straight away, it's tanked close to about 8%. The other one is Balaji Amines. Again here, there is a margin decline. Margins have sharply come off. The overall EBITDA is lower by 39%. Street doesn't like it, and it's getting punished to some extent. Bata was a lackluster set of numbers. The stock isn't doing too much, and Max Financial is reacting to the surprise CEO exit. Mr. Prashant Tripathi will be stepping down, so Max Financial has a 2% fall to begin trade.
Okay, so lots of stock-specific action, but overall as well, it's a positive morning, 100 points straight away up. Well, time to then get to our market masters of the day. Bank of America Securities 2025 India Conference has kicked off. In fact, it will kick off actually next week. The focus is going to be on growth acceleration in India. So let's discuss the view, the house view, then just ahead of that conference with Amish Shah, Head of India Research, and Arvind Maheshwari, Head of India Equities at Bank of America Securities. Gentlemen, morning. And thank you so much for joining us in person in the studio. It's always a pleasure to speak in person. And I was going through your note, Amish, you and your team's note. 9 structural drivers for India, right? Sounds fantastic. So I think in the near term, you folks are slightly cautious, given the run-up, given the valuation. So let's just start there by understanding the top-down house view on the near term. Then we'll come to the 9 drivers.
Sure. So look, near term, we had set out a target for Nifty at 25,000 for December. I think we are right about there. So we think markets are now likely to mostly consolidate as far as Nifty is concerned. Valuations are full. Clearly, we can't fault the long-term drivers or the growth in India. Macro story continues to stay well. But 21 times at Nifty, it's almost at +1 standard deviation. So if you're a near-term investor, our advice is that maybe start booking some profits. If you're a long-term investor for a 2 or 3 year period, then the view is that you should expect muted returns going forward.
Wait, but you're saying that maybe the best is over for the calendar year, despite the fact that, look at global markets have been, and it's tough to call these things, but now the courts are challenging Mr. Donald Trump and markets are rejoicing it. There's so much still going on.
And Surbi, there will be therefore some excitement to the markets in the near term. But if you would recollect, we were always pricing in that India will go through a trade deal quite soon. And there'll be benefits of China +1 on the back of that. So there has been some market rally on the back of that already. So some sectors which were going to be more impacted, like autos, maybe pharma, IT, on the worries that US economic slowdown could cut down on tech spends. There might be some rally as a relief as of now. But beyond that, India was never pricing in for a Trump tariff impact. And logically should not get, a big rally on the back of that either.
Fair enough.
Amish, just to complete the point about the way markets are going to move now in the near term. So we're in the last leg of the rally, at least for this year. 25,000 is your Nifty target. But your note also talks about 5 emerging risks that make you cautious. So tell us about that. And is there a risk of a downside from here on? Could we see some derating?
So, Rima, think of it like this, that if you were bullish markets, I'm sure you are going to talk about 5 factors, which is there is lower crude, weaker dollar, there is ongoing monetary stimulus, there is a possibility of a fiscal stimulus on the back of extra RBI dividend and excise duties on fuel, and you could possibly talk about the India-US trade deal going through, or maybe the tariffs not existing anymore. All of these put together, therefore the bullish view is that growth will accelerate.
Correct.
And we completely agree with that view. The problem is that this is only half the view, because growth will accelerate is a directional view. The moment you start to quantify it, our problem is that we think that whether you talk about capex growth, consumption growth, corporate earnings growth, credit growth, all of them will have a shallow recovery in comparison to what markets are already pricing in. Take, for example, Nifty in FY25 has delivered 5.5% earnings growth.
Okay.
We are expecting it to go up to 9 in F26, but the street was at 22, has scaled down to 14, but it's still 14, not 9.
Correct.
Same goes for capex and credit and consumption and so on and so forth. So the worry is that every result season, therefore, acts as a market correction event because earnings will keep on disappointing. So that's the first problem. The second risk that we see is that over the next 12 months, there are 6 state elections, starting with Bihar in October. And I think that will lead to a re-acceleration of populism, which is something that market never likes. Second concern. The third concern is that, yes, there is a tariff scale down, but then there is a re-appeal to that. So the point is that the global macro and geopolitical uncertainties are not gone. They will keep markets volatile, right? So when you club it all together in the context of full valuations for Nifty, maybe at almost +2 standard deviation valuations for mid and small caps, the room for error is limited. And as a result, when we are saying that the markets will consolidate, obviously it's not going to be a straight line.
Yeah.
So depending on the news flow, you will have a little bit of a volatility. And actually, we've been using that volatility to our advantage quite well. And I'm not trying to claim credit here, but because we knew that market fair value is 25, when the markets were at 26,500 back in August last year, we were negative, and we were calling for a 17% downside. When the markets actually came down to 22,000 in March of this year, we upgraded markets with the price target remaining the same as 25,000.
Okay.
And we played for that 15% rally. Now that the markets are at our price target of 25, we are asking investors
This range
to go profit.
stays 22 to 25 broadly, or 26?
So 22 now, I think, will really require some big macro or a geopolitical event. There is nothing in the horizon right now. So I think a pullback as sharp is unlikely. But could there be a +5, -5 kind of a trading range? Quite possible.
All right. Hi, Amish. Hi, Arvind. Welcome to the studio and all the best for the conference as well. So you're sounding far more, skeptical about the markets as of now, a little bit cautious at least. And kudos on that call. I recollect, when we were at lower levels, we were calling for 25,000 odd. That said, one thing that's keeping the markets afloat is this strong DI flows. But you all are calling out peak DI flows. Explain that to us. What's the rationale? I mean, because everyone talks about this financialization theme, a larger number of people contributing, but you all are calling this out. So run us through that.
So Nigel, if you look at the number of demat accounts in India, just 5 years, like January of 2020, before when the entire rally of the markets has started, or the financialization theme has started, we had about 2.7% of Indians investing in equities, right? That number is now close to 13.7%. So there is more than 5-fold increase in terms of the number of investors in equity markets. Now, I can explain this in a variety of ways, but let's say loosely speaking, you talk to any consumer discretionary company, they would tell you that 20% of India is the real market, right? So 20% of India has some discretionary income to consume something discretionary. It is only logical, therefore, to assume that if you have some discretionary money, only then will you go and invest in equity markets. Otherwise, the money that you earn is just catering for your basic needs. So if the cap is going to be at 20 and you are already at almost 14, the acceleration from 14 to 20 now is going to be slower versus an acceleration from 3 to 14. The second point to think about it is that obviously the investor who came in at 3 to 5% was richer and had more disposable income to invest in market as compared to the 14 to the 20th guy, right? So the per capita dollar that an incremental investor will now invest is also going to be lower, right? And given the valuations that as we are discussing, clearly Indian retail investor is also quite smart, and that is reflecting in numbers. So if you look at markets peaked in September last year, domestic inflows peaked in October last year. Yep. So October inflow number was $8.6 billion a month. That number since then, if you track from November, December all the way to now, has been between $4.5 to $6 billion. So markets peaked, flows peaked. Obviously, if they were to go back to 22,000, I'm sure there will be a flood of money coming in. So a retail investor will buy the dip. He will try to sell the top. And in that context, I would say that the pace of acceleration of flows that we've seen in the last 5-6 years, the pace slows and the pace now becomes more volatile versus a secular trend earlier.
That's a very interesting trend that you've noticed, absolutely. And I track those flows here. Every month the mutual fund data comes out, and you're right, 41,000 crores of inflow coming in around Diwali, and now we are down to about 25,000. So that's an interesting point. That when markets fall, people keep buying. I think that's the new normal. But Arvind, let me come to you as well. Tell us a bit more about the expectations from the conference, and more importantly, we're in an environment where there is a lot of expectation that globally investors will look away from the US. They've been very US focused all this while. Now money needs newer homes. Are you hearing that within your ecosystem? And then how is India stacking up? Because the Chinese market has the advantage of valuation on its side. Much, much better. They don't have the problems that Amish just described. So, what is the expectation from the FPI fraternity?
Sure, and thank you for having us here again. It's exciting times. There is massive interest in the conference. Last time was a super successful event, and this time it's bigger, it's better. And hopefully we'll have you at the conference as well. The number of investors is just testament to the fact that investor sentiment, despite all of this caution, is still very, very alive and kicking. Some of the themes, like you mentioned about the demand for non-US dollar assets, I think is just about starting. And it's going to remain that way for a while. It is clear President Trump wants a weaker dollar, and we are not going to fight it. So you will continue to see demand for non-US dollar assets increase. And when we look at emerging markets as an asset class, that itself becomes a very interesting play on the back of that non-US dollar demand, because you saw from, even from mid-24, the outflow numbers were massive. Now, April to date, since what is called now the Liberation Day, that when the tariff noise started, we've seen about $19 billion of inflow in emerging markets. And what we saw as outflows from the middle of 24, only 20% of money has come back so far. So I think there is still room for that to grow in terms of inflows from emerging markets. And then India being at the heart and center of now the emerging market indices, I think there will be increased amount of passive allocation anyway coming our way. And plus, whoever is looking at benchmarking against the emerging market indices, I think India becomes a very sort of safe haven. So yes, valuations are one part of the problem, but if you look at top-down macro, it's hard to find fault with India at this point. And I think that story is going to be, there's not too many large pockets of investment opportunities in the world outside of the US that will be able to absorb capital.
For the benefit of our viewers, I just want to call out the 9 themes that you've singled out in your latest report. And these are medium-term structural themes for India that Bank of America Securities likes: rapid infrastructure build-out, productivity gains, digitization, financialization, the resilience in household savings, the shift in discretionary consumption, formalization of the economy, the current account moving from a deficit to a potential surplus, and decarbonization. So all of it tying in together to present perhaps a solid medium-term picture for India. Based on this, I mean, either of you gentlemen can take this. Which are the key highlight themes that you plan to call out in the conference? What is it that, as a house view, that you're most optimistic on? Is it renewables? Is it power? Is it what's the new sunrise sector, or even if it's an old sector, and what's the sector of the future?
So I can take that, and maybe Arvind can chime in. So see, first of all, I think Surabhi, the good news is that some of these themes have been playing out for a while, but now they are coming together. So a confluence of them coming together, I think, can have a bigger impact. So to some extent, they are all connected. So let's say, for example, India is doing a lot of capex, but how do you fund that capex? So when you have household balance sheets getting better, and then they go back to savings, that saving then in turn funnels into funding the investments. And then that once the infrastructure kicks in, then you have the productivity gains to it. The formalization of economy is equal to larger, better, bigger companies growing market share at the expense of unorganized players. Unorganized players, as we know, were leaking taxes. Organized players pay taxes. So then the government gets more money, and the government then wants to use that money into productive use. So a lot of these things, I'm just trying to say, is that it's connected, and when they come together, it's a even bigger or a powerful theme. So when I started my career, I recollect there was a perennial complaint about India running twin deficits. Like we are a current account deficit and a fiscal deficit country, and as a result, we had higher rates, higher inflation. Currency was always a problem. We don't talk about that anymore. Currency is stable. Little bit up and down, it's fine, but it's markets. But otherwise, currency is stable. Rates are quite low. The gap between U.S. Treasury and our Treasury has been the lowest ever. So all of these are macro benefits, and it just makes cost of doing business cheaper. And when the cost of capital is cheaper, obviously, there are more businesses that become viable.
But you're still saying 25,000 on the index.
Yeah, meaning if I were to put a target up until December of 25, which is in the here and now, because meaning unfortunately, as we know, markets is nothing but EPS multiplied by valuation multiple. Valuation multiple for 10% EPS growth is already at 21 times. How much more are you likely to pay? We are already at +1 standard deviation. So I think the good news is that a lot of countries globally don't have that structural theme. Yeah. So at least India is a structural growth story.
We have the background. I mean, the backing.
Amish, for the longer term, India is good. Come on.
Absolutely.
I'm putting most of what I earn into the Indian market.
So Nigel, in fact, I would support it with a data point. Yeah. We looked at India 15, 20, 30 years. Yeah. You'll be surprised that after US, India is the only market globally to have delivered the best market returns in US dollar terms.
Yes.
So despite the rupee depreciation, second largest return generating market. And over a 10-year period, India is the highest number of stock compounders globally.
Wow.
Right. So clearly, there is need to find the bottom-up ideas. There will be compounders. Market will grow structurally.
Yes.
But for the near-term investor, 25,000 is the full price.
And
You asked-
also just one more point on that, because the SIP investor, I think only in the Indian markets and the United States have made a lot of money. So keeping your SIPs going, that's something that our retail audience obviously, looks for some guidance on. I personally do that as well. So keeping your SIP going, the longer duration, maybe the near term we're hitting a peak on the headline index, but longer duration, India should do well. Another quick point, since you all were talking about this rate easing cycle, a couple of sectors will do well.
Sure.
One such theme you all are pointing out is autos. Could we narrow down a little bit, because the rate easing cycle will give more amount of money in the hands. You have the tax cuts as well that are coming there. So what do you like from the auto pack? Either of you all could take it. So,
and I will broaden that answer to some extent, Nigel. We are of the view that economy needs a stimulation. Unfortunately, there is not too much of room from a fiscal side to stimulate right now. Therefore, large part of the onus is on monetary. Yeah. Monetary, there are plenty of tools, and the government will use it, or the RBI will use it. So because monetary stimulus will continue, we are broadly positive on everything which is rate sensitive, domestic cyclical. So that includes financials, autos, as you mentioned, REITs, real estate, some internet. So this is all that we like. Within the auto space, particularly, we are more constructive on the passenger vehicles right now, followed by two-wheelers. Given that we think that the infrastructure growth is relatively going to ease, we are not that optimistic on the commercial vehicles as of now.
Arvind, CapEx has been a big theme for our markets. It's, stocks have done very well. In fact, it's one of the 9 structural ideas for you, good infrastructure rollout. Yet you are underweight on CapEx-linked plays like industrial cement. Why is that?
So, look, ultimately what Amish also pointed out earlier, if there is elections coming up, there is more populism, generally that money goes away from CapEx into doing these kind of measures. And it becomes harder then for, anyway, execution challenges remain in that segment. So as much as we want the CapEx push to be there, you have to be able to execute the allocated outlays. And if that doesn't come through into execution, ultimately the growth challenge then becomes a bottleneck. So which is why to what Amish was mentioning about the money tracking financials and autos, rate sensitives, and we are seeing that in April to now, whatever money flow has come through from foreign investors, you can already see more than 50% has gone into financials if you track the data. So clearly the market also wants to be where the policy support is going to be.
You're also cautious on momentum plays. What would you classify as momentum plays? Would it include, say, for instance, defense, which has had a fantastic run up until now?
I'll let Amish take that.
So, Rima, the short answer is yes.
Defense is one. What else comes in momentum? And then tell us more about it.
So I would say defense, SOE pack in general, railways, industrials, power utilities. Primarily, the bigger definition of it is CapEx-linked stocks. So as Arvind mentioned it, if I were to just put some numbers to it, central government CapEx between 21 to 24 was growing at 30% CAGR, is now likely to grow at 10. State government CapEx was growing at 21% CAGR, is now likely to grow at 8 or 9. Right? The overall CapEx pie was growing at 20% CAGR, is likely to now be at 10. So there is a rapid scale down in terms of growth or the second derivative that we are talking about. On the other hand, subsidy bill of India, states and center put together was $91 billion back in FY23. FY24. In 2 years' time is expected to be $127 billion. So there's a 40% increase in a couple of years' time.
And this moderation in CapEx, is that a structural theme? Because it'll keep putting a lid on stocks that you're talking about.
So in terms of the growth rates, yes, given where the tax collection growth rate numbers are. Meaning, is there a stoppage to CapEx? Not really.
No.
But are we in the era of growing at 20+%? We are not in that phase anymore. right? So the nominal GDP will grow at 10, 11. I think capex will grow at the same run rate. So if you had an economist in the room, he would argue that, capex as a percentage of GDP is at least a flat line. It's not shrinking. So why are we complaining?
It's the alpha.
The capex analyst in the room will argue that, the growth is down from 20 to 11, and therefore stocks needs to adjust to the valuations therefore.
I'm glad you brought that up, put it on the table before anybody could ask, counter questions. Finally, gentlemen, where are you on the mid-cap, the SMID versus large-cap universe debate? Because the narrative so far this year, and it's played out, is that large caps offer a lot more value. Just stay with the big boys. And that's where the money is. How do you see it now?
If I take a fundamental cap on, then I clearly think that SMID caps are more expensive than the large caps. There are various ways to argue it. I will just give you a couple of data points. In the last 3 years, the growth premium of small and mid caps over the large caps was 16 percentage points, 16% extra growth. Okay. So clearly that justified valuation premium. Yeah. Right? If you go into the next couple of years, that growth premium is going to shrink to 400 basis points. Okay. But the valuation premium at the peak was 50%. Right now is at 45%. So growth premium has massively shrunk. Valuation premium has hardly shrunk. So from a fundamental basis, I would say that large caps are cheaper, mid caps are more expensive. But from a flows perspective, till the time the money continues to rotate into small and mid cap mutual funds, as a mutual fund manager, what choice do I have but to chase the same stocks and bid them at higher valuations?
When money comes in, all bets are off. Then all arguments fail, right? You don't stand in front of a moving train.
There is a lot of supply of paper as well coming through, right? So that is, and that will, once the large caps and the big boys have raised some money and that is out, you will see a whole host of mid, small cap names also. And look, I think
I'm glad you brought that up, Arvind. Could that put a further lid on the market's excitement because there's so much of supply in blocks on a daily basis? There are IPOs coming.
Look, I think at some point it will be a cause for concern, but I think we are starting out from a very low base, right? We had a very dry Jan to April. So 4 months, literally, we had like $1.65 billion in cap raises in deals across all segments, whether it was IPOs and blocks, etc. Now, this is the first month in May where we have seen almost $5 to $6 billion. Now, if you recall, second half of last year, we had almost $7 billion every month. And ultimately, obviously, that at some point started to fatigue the secondary market. So I think it's still early to call that a reason for concern. And obviously, as the market expands, the free float expands. I think we want more companies listed. There are some great stories in India. We want them to come into the listed space and get all retail investors to be able to participate as well. So I think it's great for a great outcome structurally for the markets longer term. Okay, all right, gentlemen. Good hearing your thoughts. And in fact, on that point, it could explain why the mutual fund industry was sitting at such elevated cash levels. I think it was around 2 lakh crore. Pure equity AUM as a percentage are around 7%, so prepared for some kind of supply. But thanks a lot for coming down. We take your thoughts on boards and wishing you all the best for the conference. Look forward to having you all post the conference as well. All the best, gentlemen.
Thank you, Nigel. Thank you.
Well, time to slip into a short break. On the other side, we'll get chatting with Vishal Goel of UBS Securities. We'll talk about the Indian banking sector. Stay with us. Welcome back. Well, the market's still holding with some mild gains, though we have come off the top of the day. But there are plenty of stocks actually from the broader markets that are doing well. Federal Mogul Gots, after a while, this one's come on the radar. It's up 15%. Vito Switch Gears, well, that's up close to around 15%. So I don't know what's going on there. Welspun Corp, the one that we spoke about earlier today, well, that's making almost on the verge of making a fresh 52-week high. So broader markets, plenty of stocks doing a thing of their own. But as promised, let's focus on the banking universe now. Are banks back to the golden era? Are asset quality woes, unsecured lending concerns a thing of the past? Let's discuss this and more with Vishal Goel, the head of India Research and banks analyst at UBS. Hi, Vishal. Good morning. Thanks a lot for joining in. Well, before we get to talk about PSU, private banks, and the entire industry, I just wanted to ask you about credit growth. That's yet to show signs of picking up. In fact, it's moderated in the last few months. What kind of credit growth are you all working with? And if you could tell us, do you expect things to pick up from here on?
Yeah, hi. Thanks for having us. Clearly, I think the impact of tightening, which we have seen in last years, plus the growth slowdown, which we saw in the last half, it's reflected in the slowing credit growth. I guess from here, like from the current 10% number, we are expecting it to go towards 12% by the end of this year. Multiple tailwinds we have for credit growth this year. We have the consumption stimulus from the government, which should start, reflecting somewhere, this year. Also, the liquidity easing that also enables banks to start lending more than what they've been doing. Clear constraint has been deposit growth. That also generally would start improving towards end of this year. And also, I think if you look at the risk weightages from RBI recently, they have in fact relaxed all those. So the overall environment, especially from the regulatory point of view, is easing plus liquidity. I think this should start, reflecting in the credit growth over this year.
Vishal, thanks for joining us from the sidelines of your conference. Thank you very much. This is Rima here. Last month, you all turned bullish on some of the PSU banking names. So I can see an upgrade on SBI to a neutral, an upgrade of Bank of Baroda to a buy. Tell us the thinking on PSU banks right now. What's the narrative playing out?
Yeah. Hi, Rima. See, I think we've been cautious on PSU banks, especially due to their lower profitability and their ability to keep profitability. So they gained because of falling credit costs. Generally, their operating profitability has remained weak. We have reached a point where their profitability, especially in terms of core PPOP, is stabilizing. Plus, there is no major pressure from corporate lending. Also, their exposure to retail unsecured is generally small. I'm talking about the overall pack. And I think all those, again, gives us some confidence on their credit cost. And valuation, given their underperformance, I think have become reasonable. So those were the views from cautious to more like a neutralish view on state-owned banks. We still prefer private sector, banks, as a pack in terms of overweights, just to clarify that.
All right. Speaking about the bank that's been in focus for a variety of reasons, may not be the best, is IndusInd Bank. And a lot of news flow out there. But a stock that was at around 1,600, today it's less than half that price. Give and take everything, do you think bulk of the bad news is in the price? Or do you think things are too fluid and, there could be a negative surprise coming out of somewhere that you'd rather stay away?
Yeah, Nigel, sorry, I'll not be able to discuss stock specific due to, our internal compliance. I think, yeah, so maybe I can make a general comment on the industry, but maybe not stock specific.
But do you want to make a general comment on IndusInd Bank? Will this have any kind of ripple effect? Because what we're seeing right now is that incremental bad news is not further hurting the stock price. Like, for instance, today there are allegations of the SEBI investigation throws up insider trading. It's not that the stock has fallen further. So, I mean, from a shareholder point of view, how should they go about thinking about a stock like IndusInd Bank without getting into specifics?
See, yeah, again, I think without discussing stock specific, I'll tell the way I would look at this is we have had similar cases in the past, right? There have been a couple of such banks who went through a similar journey, I mean, in a different form, but they had serious losses, change in management, regulatory interventions. And post that, what typically happened is you see a consolidation in metrics, like the growth disappears. The focus goes back in terms of protecting the depositors versus shareholders. That generally is the script from regulator. And in generally the period followed by maybe 18 months to 24 months in that period, you typically see no activity, from such companies in terms of growth. Generally, it's a cleanup period. So that's been the case in previous, similar cases.
Any big anti-consensus call, by you, not on stocks, but even in terms of a trend? I can see Bajaj Finance, for instance, is a sell for you, and that seems anti-consensus to me.
Yeah, see, again, I think if I think about broader sector themes, the way we looked at is we've been cautious on the sector for last 12 months or more. We turned constructive, recently, and clearly there are reasons for that. I think when I say anti-consensus, probably when I look at valuations, which is still below average for the sector, I think clearly there is room for making money in this sector. And we think the regulatory landscape is turned favorable for the banking sector. Like we have seen multiple tightening in the last 2 years, which is getting now relaxed. If you see, incremental last 3 months, I feel more relaxation could come through in the next maybe 12 to 18 months. Second, I think the consumption credit cycle, the unsecured credit cycle, that also has seen like NPL buildup. It's probably in the last stage of cleanup in our view, as per the data we are seeing. So the pressure on credit cost also should start easing from here. The only thing which is left is NIM compression due to rate cuts. That I think will have to factor in this particular year. But otherwise, I think if I look at the compounding on ROE, I think the sector should be comfortably compounding at anywhere between 13 to 15% on ROE and reasonable valuation. So, yeah.
As a house, how many rate cuts are you all factoring in?
See, our economics team is expecting 75 bips of additional rate cuts this year.
Okay, so Vishal, hi, Surabhi here. Just to kind of recap the main headlines from this. For this year, what is your expectation of credit growth system-wide, banking system-wide, given the rate cut expectations? And just purely in terms of growth, which kind of lenders could be ahead?
Sure. See, we are expecting 12% credit growth. So this 10% should improve towards 12%. That's our view on the credit side. We feel consumption credit would drive this growth because we have seen multiple, I would say, stimulus waiting actually to come through in the next 12-18 months. That should support growth. Falling interest rates, the housing cycle itself, that also should accelerate towards the end of this year or second half of this year. So a lot of, I would say, growth will be visible in the second half of this year in terms of loan growth.
So finally, for this year, the next 12 months or so, the biggest driver of stock prices, of course, is going to be, the credit metrics, credit growth itself. What else to watch out for? What will be the biggest factors that will lead to perhaps the best delta in stock prices, whether it's banks or non-bank lenders?
Sure. See, I think growth will be, as you said, will be the biggest factor because we've been seeing lack of growth for some time. I think the second factor will be stability in net interest margins because currently there's a lot of uncertainty around how much the NIM would fall due to the repo rate, basically how much banks would be able to retain, right, or offset versus the repo cuts. So that stability also will be reassuring because then people will have some visibility on FY27 NII and FY27 NIM. And lastly, of course, the last leg of unsecured credit cycle, that's still going on. I think the incremental data points are encouraging, but once we see that kind of fully stabilizing, then banks will also be able to grow the unsecured credit with more confidence going forward. So that's the other data point to watch out.
Thank you, Vishal. Great conversation. Enjoy the rest of your conference. Look forward to the next one. Now let's get in a corporate conversation. EID Parry. Now the Q4 revenue saw healthy growth, but margins were under pressure. For FY25, most of the businesses did well, barring the sugar business, where there was a revenue decline of about 13%. The sugar business also reported losses, and that's on account of the lower crushing. So how is FY26 shaping up for them? Let's connect with Muthu Murugappan, CEO at EID Parry. Thank you very much, sir, for joining in. This is Rima here. That's the first question. In FY25, except sugar, the rest of your businesses did pretty well. So, for instance, distillery revenues were up 38%. The consumer products business revenue growth was 25%. Nutraceuticals saw a growth of about 18%, but sugar was subdued. For FY26, how would all these individual segments fare for you?
Very good morning, Rima, and thank you for having me on the show. Yes, it was a challenging year for the sugar business on account of lower cane availability, primarily in TN and AP, and also lower cane recoveries. I think this impacted our sugar segment performance. Looking ahead to FY26, I think challenges in TN and AP continue. We are hopeful that planting will improve, in the upcoming season. But for this season, we do see challenges continuing in TN and AP. However, which is about close to 60% of our crushing capacity, looks much stronger. So that.
Okay.
So, sorry.
There was some sugars. We are seeing good monsoons. They've in fact started early.
I think that line
Sorry,
is slightly that line is slightly patchy, Mr. Murugappan. If you could just recap for us. So you've done, in terms of sugar revenues, this year you've done 1571 crores, which is obviously a decline from last year. The current year, do you expect some of the crushing issues to come back on stream? What is the sugar revenue that you're hoping to achieve this year? If not revenue,
so in the upcoming year, we're still.
Yeah, please go on.
So we're still, more cautious on the upcoming. Yeah, we're still more cautious on the upcoming year because of lower cane availability in TN and AP. Also, we're seeing a trend of release quotas, coming down. So from the sugar perspective, it could be a challenging year going forward. Karnataka, however, looks good, from a crop perspective. More broadly, I think monsoons are there, and I think they are expected to be normal. So this should strengthen the general availability and capacity utilizations across the sector. From a price standpoint, given that there's likely to be more sugar in the domestic balance, pricing might correct. But then again, we'll have to see what kind of policy interventions are made on exports as well as on ethanol. And hopefully positive interventions here will bolster pricing. But we're still, quite cautious and rather neutral on the sugar segment.
Okay. All right. Hi, Madhu. Good morning. Good to see you. We're Nigel on this side. Give us a couple of details then on the distillery part of your business. What kind of volumes did you do last year? And since I think you have some capacities that have come on, FY26, we should see a bit of an uptick in terms of volume. So if you could give us a brief number in crore liters.
Sure. Thanks, Nigel. The distillery was a good story last year. We did about 16 crore liters of volume. Some of our capacity came on stream.
Okay.
And
for the coming year,
in F24, so that was a good growth.
If I got the numbers correctly, sir, Muthu, it was 16 crore liters last year.
That's 60. Correct. For F25, it was 16 crore liters. F24 was 12.5.
Okay.
And the upcoming year as well, we should see a slight uptick in distillery volume. However, on the margin front, we have seen some challenges. Challenges on account of ethanol pricing, that hasn't changed. The offtake pricing hasn't changed for close to 3 years now. Also, given we had lower cane feedstock, this increased input costs. We had to insource a lot of molasses, which was quite costly. So this has impacted margins. We're down to about 8% on EBITDA margin, as opposed to 12.5% in F24. And we expect this 8% trend to continue. Ideally, if there are some positive policy interventions, this could move higher.
Okay, all right. Just a couple of questions. From 16 crore litres, what should you end this year with? 17, 18 crore at least? Should that be a doable number? Is it higher? And also, you all made a pitch for this ethanol price hike, right? What is the quantum you all were looking forward to, and how optimistic are you all about that seeing the light of day?
Sure. So in terms of volumes, I think we should comfortably move to 17 crore litres. And, I think if there are positive policy interventions and some improvements in cane planting, that could, go even higher. In terms of ethanol price, I think industry has made some representations. I think the policymakers have, given us detailed hearings. I think industry representations have been to the tune of 4 to 5 rupees. However, we'll have to see where that lands. Policymakers have been receptive to our representations. We remain hopeful.
Muthu, the ethanol price in the last year, November 1 to October 31st sugar year, that was 57.97 from what I'm seeing right now, basically around 58 rupees. Would that be right?
For B-heavy molasses, yes.
Okay. Now, which is the feedstock which you use? I mean, because you're saying that distillery, the volumes are fine, the top line is growing. The problem is with the margins. So what kind of a price increase would make it more viable for you? And also tell us about different feedstock. I don't know if you're using maize, for instance, because there was an increase on maize as well.
So we use 3 feedstocks. We use B-heavy molasses. During the crushing season, we use a little bit of sugarcane syrup as well. That pricing is about 65 odd rupees. We use maize as well. Maize is about 71.8. Maize is about just under 20% of our capacity. It's only one distillery which has maize capacity. So we use these 3 feedstocks. Ideally, on the sugarcane-based feedstock side, it would be good to see an improved offtake pricing. I think we would resonate with the industry ask of about 5 rupees here.
And I mean, assuming this is an assumption, where would the margins be if, let's say, the industry got what it's asking for, which is about 5 rupees? I mean, as of now, what is the projection minus any ethanol price increase? What's your projection of margins for the distillery business? And how much could they look better if there is this price increase that comes through this year?
So, Surabhi, as mentioned, I think we will hold margins at 8% if nothing changes. If I take you back 6 to 7 quarters, I think we were around 20-21% EBITDA margin, and we were quite comfortable. It would have moved slightly north, if that trend of offtake prices was going to move up. And we were very happy with that because we, just coming off a significant capex program on ethanol. And I think this would really keep our payback aspirations in check. However, with these margins of 8%, I think there would be challenges around the payback periods. If there is a price increase to this tune, I would say the margins would move back into the late teens.
Late teens, okay. That would, of course, your shareholders would really like that. So it all is now hinging on this price increase for ethanol on the B-heavy molasses. Muthu, I just want to come to your other business, which has been growing really well as well, and that's consumer products. I mean, there the revenue from about 530 crores has grown this year to about 880 crores. So it's a substantial increase. Give us an overview. I mean, what can we expect from this business? Any new likely launches? And again, the margin profile that you're aiming for this year for this business.
So I think, Surabhi, this is a new business which we're building for the future. We have a multi-decadal view on this. It's really in branded food, FMCG. We started off with sweeteners, and if I was to focus on the sweetener segment first, I think our branded white sugar volumes are holding stable. We've put a lot of focus in on the value added, especially the browns, which is jaggery, brown sugar, etc. And I think that has grown. Our value added component is about 12% of overall sales. This is, of course, margin accretive. And also with the trend of consumption of sweetener moving towards more healthier sweeteners, this is in line with the sort of movement of the market. We launched into staples this year, which is beyond sweetener with millets, dal and rice. And this portfolio fared well. It was a good start. We did just under 300 crores of revenue. This will continue. I think we are focused on building a strong organization, a strong team.
So how much growth this year in this business? I mean, just a sense, do you touch 1,100 crores of revenue more?
On the non-sweetener side, I think we'll grow another 20 to 25%. On the sweetener front, we will actually focus more on growing the value-added piece. I think we're quite happy with the base business of branded white sugar that we have. And on the non-sweetener front, on the staples front, rather looking at bringing in more products which are margin accretive on the lines of convenient foods, which is your roti mixes, dosa mixes, upma, so on and so forth. So I think we'd focus on that. Of course, our focus is also on distribution. We closed F25 with a little over 2 lakh outlets of coverage. This will move closer to 3, and we will focus on deepening our presence in the quick commerce, e-commerce, as well as the larger modern trade channels.
Thank you very much, Mr. Murugappan, for joining in. That's EID Parry for you. For the markets holding up with a gain of about 0.3%, the Nifty is above 24,800. Let's find out if there are any 10 a.m. trades. Mitesh Thakkar is back with us. Mitesh.
Yeah. So I think, the index has come off, as I said, it's mostly a market which is sideways, just chopping around, and not too much of a directional bias. On the stock side, I have one buy and one sell. Bharat Forge is something which has broken into a fresh swing high. So buy here, the stop just below levels of 1255 for targets of 1300. And Phoenix Limited is on the negative on the sell side. I would suggest a stop just around 1595 for targets of 1530.
Okay. All right, Mitesh, thanks very much. We'll take a very quick break on that note. Come back. Latest commodity market action coming up with Manisha Gupta. Welcome back. So, as promised, let's go to the commodity markets. Equities are holding up fine. Nifty is still up about 70 odd points. Commodity markets now. Manisha is in here, with us in the studios. Manisha, what's the headline? Mr. Donald Trump is keeping the markets excited.
Oh, absolutely. Since he's taken office, even before that, it's been quite exciting in the commodity markets here. But overnight, with the kind of statements that we've heard from the federal court, trade court, is what really seems to be moving many of these commodities. So, overnight, we saw the crude oil prices gain up by a percentage point. And after the U.S. Court of International Trade has declared tariffs unlawful and has also said, or rather ordered tariffs to be vacated and blocked, we've seen some bit of an ease in business here. And many of the industrial commodities, energy as a space, has seen some buying in the overnight markets there. Well, apart from that, what really seems to be supporting the crude oil prices also is the OPEC plus ministerial meeting that happened yesterday, and they haven't moved the current output quota. So that was supportive as well. Having said that, the OPEC 8 plus are going to be meeting on Sunday, that is 31st of May, and they could be talking about increasing production from the month of July to the tune of 411,000 barrels per day. Remember, they want to increase production and bring it to 2.2 million barrels per day by the month of November. So statements on Sunday perhaps could move the markets on Monday here. Having said that, it also is about U.S. barring Chevron from exporting crude from Venezuela. That is a developing story and can have implications in sense of supplies going forward. Chevron can continue to hold its assets in Venezuela. but it cannot increase assets or export Venezuelan oil. So that's a bit of a tricky situation there. Also, the markets are anticipating that the summer season demand is going to be on the stronger side. That starts from mid of June. The markets also are looking at a heavy Atlantic hurricane season within that part of the world that perhaps will also bring premium to markets. And then the Canadian wildfires have been going on for too long and could be hurting supplies, is what the reports really seem to be suggesting right now. The markets have a keen eye on the US and Iran nuclear conversations as well. We've seen 5 rounds of conversation without much progress there. So what happens on to this one? There's another meeting happening this weekend. Keep your eyes on that one as well. The US inventories also have declined by nearly 4.2 million barrels in the previous week, adding support. So when you look at all of these factors and fundamentals, suddenly it seems to be turning for the positive for the crude oil prices. Other one that I want to add is the Baker Hughes report, which says that the operating oil rigs are now at the lowest since November 2021. So that drill, baby drill, also doesn't seem to be really happening on ground there. What the markets will now watch out for is the first quarter GDP estimates that would come in from US. It also is going to be about the weekly jobless claims that comes in today, and the PCE price index data comes in tomorrow. So it's going to be a loaded next couple of days.
Okay, all right, Manisha, thanks a lot for that. Well, let's focus on a couple of stocks that are moving around. In Welspun Corp, that's the one that delivered its set of numbers, and let's run you through the top points why the street likes this set of numbers. First up, in terms of an EBITDA, in the quarter it came in at around 460 crores, and we pull up a chart, you'll see it's been steadily improving from around the 350, 400 crores, it's moved to 460, and in fact that's almost the record high that we're seeing. So EBITDA per quarter coming in at 5-quarter high. Next up, the guidance, very, very impressive out there. Last 2 years, the EBITDA guidance that they lay out, they go ahead and they've achieved more than that. Now, for this year, if you compare the guidance that they've given of around 2,200 crores with what they've achieved last year, they're guiding for an 18% growth in terms of an EBITDA growth, which is fairly good. Keep in mind that they include the other income in the EBITDA calculations as well. They had a small net debt as of the last year. Well, that's turned into net cash. So now cash in the books is close to around 5% of the market cap, though they have a big capex plan for the next few years. The order book as well, very impressive, close to around 19,500 crores. So they've got order visibility for more than the next 1 year or so. And since things are looking up for them, they have announced a greenfield project in the United States. That's for LSAW pipes. They've given us a lot of reasons out there, but they are saying that demand is very, very strong. And remember, for the US business, which was virtually absent for the last year, that gives them better margins. So put everything together, the stock is almost at the highest level we have seen in the last 52 weeks or so. Currently, that it's up close to around 8%. Good set of numbers, good order book, fabulous guidance going ahead.
Okay, that's Welspun Corp. Stock is fired up in excitement today on the back of those numbers. By the way, as we take our next break, just a quick check on the market. It's cooled off a little bit from that initial pop of almost 120 points. The Nifty has now come down to a gain of just about 70 odd points. The weak hands include the non-banks today. Very interesting. Bajaj Finserv, Bajaj Finance, Jio Finance, Shriram Finance, HDFC Life. So the non-banking financials, they are the ones that are not too excited this morning. And then there are 1 or 2 other names like Tata Consumer and BEL. So that's where the slight sense of caution is in the market. But otherwise, I mean, it's not bad at all. Tech and consumer-facing, tech and global-facing names like metals doing really well. So JSW Steel, Infosys, these are the stocks that are retaining a bulk of their gains. And IndusInd Bank, unshaken, unstirred with this whole insider trading issue coming up. Because remember, it is, many of these 5 key management personnel, they've anyway been sort of moved out. They're no longer with the bank. So let's see. Market not too perturbed with the SEBI order that came in yesterday. That's about 1% on IndusInd Bank.
Okay, Som Distilleries, by the way, the numbers were fine, but the stock is now nosedived. It's down close to about 10 to 11%. And on the way up, buying has emerged in names like MMTC and India Pesticides. Good volumes, on these names, and big moves on the way up. Well, that brings us, we're going to slip into a break on that note. On the other side is our special segment. It's The Economy. Lata will discuss the state of bond yields and banks in India with Ashish Gupta of Axis and Rikin Shah of IFL.
India's 10-year bond yield is at 6.7%. This is the lowest we have seen it since September 2021, 3.5-year low. The immediate trigger, of course, is the record 2.7 trillion rupee dividend from the Reserve Bank to the government, which is the largest historically, even if it is a little lower than street expectations. On the other hand, against the bond yields is the US 10-year yield. They've touched 4.5% this morning after the court announcement setting aside the Trump tariffs, at least the reciprocal tariffs. The 30-year bond yield is at 5%, maybe even crossing the 5%, again, because of the court cancelling the Trump's reciprocal tariffs. The rise in US yields has led to foreign funds selling nearly $5 billion of Indian bonds in April and May. So what we are trying to understand today is where are Indian bond yields headed? There's a positive in terms of liquidity and a negative in terms of FPI sales. And what does all this mean to banks? I have with me Rikin Shah, the Senior Vice President of IIFL Capital, to talk about this and about banks in particular. In a bit, we will be joined by Ashish Gupta to speak to us about bond markets. Rikin, first to you, because we have a big banking event on our hands. Before I come to bond yields, I wanted to ask you about your views on IndusInd Bank. With the latest salvo from the SEBI, you have not seen much of a change in the bank's prices, but how would you approach the bank?
Hi, morning, Lata. So, IndusInd Bank, we know that there have been multiple frauds that have kind of been communicated to the market in the last couple of months. While the interim order passed by the SEBI does, on the insider trading, does implicate the ex-MD and CEO, given that they are no longer part of the system, we have not seen the stock price getting impacted by that. But focusing on the fundamentals per se, I think the near-term fundamentals appear challenging for the stock. The growth is likely to be very subdued given the liquidity constraint that they will be grappling with. The incremental funds that they are raising, they are still at 50, 70 basis points higher than what the other peers are raising at, and hence the margins will remain under pressure. And the path to a normalized 1% ROA seems a bit long drawn from the current moment. But while this is the fundamental, I think the next couple of months, the focus is likely to be on the new CEO name, which would be first communicated to the RBI and then subsequently appointed and approved by the RBI. So that's where the near-term focus is likely to be. And post that, we expect the stock to start behaving more looking at how the fundamentals trend.
But is the worst in the price with this negative news? Does it become a buy?
Given that the next 1 to 2 months, the news flow is likely to be a bit more positive vis-a-vis what we saw in the last 3-4 months, do not expect a significant negative stock price action from the current levels. However, as I mentioned, post the CEO appointment happens, we expect the stock to start reflecting the fundamental trends, which we expect to be a bit more challenging still for the next 12 months.
Okay, now let me come to the overall banking space itself. We are seeing this fall in government bond yields. Wouldn't this be a challenge to banks in terms of their ability to, charge higher rates for, say, NBFCs or for any corporate, even for MSMEs? So do you expect, therefore, bank margins to be under pressure because of the fall in yields and because of the expected rate cuts?
Sure, Lata. So, we wrote a report recently where we said that the banking sector as a whole is ripe for a near-term breather. The essential argument underpinning this call is that given the rate cuts that we are likely to see, 50 bips have already happened, and the house view is that at least another 50 basis point will happen in this calendar year. The margins are likely to be under meaningful pressure. So we are expecting the margins to go down by 20-25 basis points in the next 3 quarters and subsequently recoup or stabilize thereafter from 4Q or FY27 onwards. The typical margin sensitivity says that for a 25 basis point of rate cut, you see margin pressures of around 5-7 basis point. And while the liquidity has improved and the cost of deposits, both on the savings account, time deposit, as well as the bulk account is going down, the full transmission of that will take a few quarters to play out. And hence, we expect significant margin pressure for the large private banks in the near term, followed by the PSU banks. And the least impacted should be the mid-sized private banks who have higher share of fixed rate loans and hence lesser margin pressure vis-a-vis the other two categories.
Okay, got that. I'm just coming to you in a minute in terms of more nuances for banks. But let me invite Ashish Gupta, the Chief Investment Officer of Axis Mutual Fund, into the conversation. Good morning, Ashish. Thank you again for your time.
Good morning.
Well, I began by, triumphantly announcing that bond yields at 6.17% are a 3.5-year low. And this is even without the Reserve Bank rate cut. If the rate cut were to come, and given the liquidity, it looks like the call market will go even below the 5.75% that it now is. So, what is your view on US 10-year, on India 10-year yields and on the call yields over, say, the next 6 months?
No, I think I agree with you that RBI has taken significant steps, both in terms of the rate cuts they have done, but more importantly, the liquidity infusion that they have provided. And at the lower end, therefore, the effective easing is also not just the rate cut, but the corridor that has opened up between repo and the STF rate of 50 basis points. So I think the flow for the short-term rates is falling much more, almost about 50 basis points higher than the cut in rates. On the long end, on the 10-year, I think given the drop that we have already had, I think market is built in to a significant extent the rate cuts that are coming. We believe a large part of the 10-year rally is actually behind us. And what we will probably see is more steepening of the curve rather than a parallel shift down in the curve. So we actually expect the shorter rates to fall more than at the longer end, because at the long end, a lot of rate cuts have actually already been priced in.
Okay, so by the end, I mean, just to get an idea of how far the rate cuts and the liquidity can go, the government hasn't spent the money, the nearly 3 trillion rupees. That also will come into the banking system. Yeah. And looks like we have a much more bountiful monsoon than we expected, say, a couple of weeks ago. So are you looking at a 5-quarter repo? I mean, can repo rate cut go that far? And therefore, can call rate go even to 5%?
So our view is actually rate cuts to be about 25 to 50 basis points from here. I know there are the forecasts in the market that are calling for even larger rate cuts of about 75 basis points or so. But we have to be mindful that in addition to domestic factors, we have to be cognizant of how rates are globally. And globally, unfortunately, rates have not been coming down. And actually, if you see in the last 9 months, most major markets, whether you look at US, Germany, Japan, even Brazil, bond yields are up between 50 to 150 basis points, while in India, as we talked about earlier, at the long end, bond yields have come down by about 70 basis points. Having said that, as of now, the higher global bond yields is not really curtailing the room for the RBI, because the dollar index has actually been weakening despite rising yields. And that allows RBI to conduct its monetary policy looking at domestic inflation.
1 minute, Ashish. We have seen $5 billion move out of Indian bonds in April and May. At some point, this might accelerate even more. We got, 40 billion or 20 billion in the last several months, in the last 18 months or so. If there is a very big legging out, Do you think that caps the Reserve Bank's both liquidity and interest rate elbow room?
So actually, foreign ownership of the Indian bond market is not very material, right? Actually, foreign ownership in India is much more in the equity markets, both in the FII and FDI route. The good news is that over the last month and a half, we have seen foreign portfolio flows turning positive. And if you see, therefore, RBI has, despite the $5 billion of bond outflow that you mentioned, we have actually seen forex reserves again started getting accumulated. And we are again moving close to nearly $700 billion of forex reserve. So I think given that construct, RBI still has the elbow room to pursue its independent monetary policy. But I think it will also make them a bit more conservative on how aggressively they want to take down rates.
Okay. Well, very quickly then, what's your view on, which is what I was discussing with Rikin, do you expect bank margins to take a fairly severe hit, considering that, the actual rates are lower than what the 10-year is indicating?
So I think, as Rikin also mentioned, there's no doubt bank margins will be under pressure. I think, having said that, the easing monetary policy was always expected to pull down bank margins. What has been a positive surprise over the last month is that banks have actually been willing to take a cut, particularly the private banks, in their savings deposit rate. And that actually protects the margins much more compared to really the pace at which you take down the term deposit rates, because the repricing is immediate. I think what, in terms of stocks, will be an equally important indicator is how does credit growth respond to these lower rates and better liquidity? Because if you see last 2 years, even though bank margins were very strong and among the highest that they have had, the stocks had not done anything till about 6 months ago because credit growth outlook was weakening. And I think it will be a positive for the banks if on back of this surplus liquidity, sharp cut in interest rate, you see a rebound in loan growth. And if, say, we can go back from 10-11% loan growth to 15-16% loan growth, I think investors should be quite happy with that.
Well, at least there are two problems for that. The last IIP number we got is an 8-month low. The number that we got yesterday. It doesn't look like credit growth is really picking up. Rikin, your thoughts? Actually, two quick questions because we have to wind up out of time. What do you expect in terms of credit growth? It's not just margins, but looks like even credit growth is not very good. And therefore, the second question separately, should we stop looking at margins and start looking only at ROA when we pick banks?
Sure. So in terms of the credit growth, the long 10-20-year CAGR of banking system loan growth has typically been around 10-11%. But what we had seen in the last couple of years, the system loan growth had accelerated to almost 16%. Now, since then, it has been steadily decelerating. And the latest fortnightly print shows that the banking system loan growth is down to around 10% YOY right now. And we expect this banking system loan growth to slightly pick up from current 10% level. But the view is that it's unlikely that it will go back to 15-16%. The inherent reason for this softness in the credit growth in our view is twofold. First one is that the corporate capex cycle, first, it's not significantly or cyclically turning up. And whatever the funding requirement of corporates is largely being catered to by the bond market, ECBs, and to some extent, some NBFCs. So the large banks have actually lost 25 percentage point of market share in the last decade. So the corporate demand and corporate loan growth is not coming. On the other hand, we have seen that some of the larger retail loan segments like housing loan, etc., we have done a study which shows that whenever the rates are cut, the loan growth in lower yielding segments like home loan also decelerate. So these are the two drags. On the other hand, we expect some pickup in the unsecured loan growth following the significant slowdown in last 1.5 years, and some MSME growth to be there. So from 10%, it can go up to 12%, but unlikely to go back to 15-16%. And margin, as we discussed earlier, is more of a cyclical pressure. We expect all of the margins that are being lost in this year to be recouped back in FY27. But ROA in FY26 is likely to go down by anywhere between 10 to 20 basis points. So investors will have to see through this cyclical pain and focus more on FY27 to be invested in the banks.
Okay. Actually, completely out of time. A one-line answer from you, Ashish. Would you also be as bearish on banks as Rikin is? ROA under pressure this year?
I agree with Rikin that ROA will be under pressure this year. I think ROAs will certainly come off from the highs of